Welcome to the deep dive. We are hacking through the noise today, really focusing on cryptocurrency security.
Mhm.
You probably know these are digital assets. They run on decentralized ledgers, supposedly trustless.
Right.
But our mission today isn't just defining crypto again. It's figuring out what actually keeps it secure and, maybe more importantly, where the real-world attacks actually happen.
Yeah, we're trying to cut past the market hype, get to the core mechanics.
Exactly. Analyze the fundamental security stuff and the huge risks that, well, they often get buried under all the trading drama.
And it's so important we do this. There's just a flood of information out there, white papers, crazy market reports. It can really muddy the waters.
True.
And the fundamental thing, the piece you have to grasp, is the historical problem that, well, it's stopped digital cash from even existing for decades. It's the double spending problem.
Okay, right. Let's unpack that. Double spending, I mean, it sounds like what it says on the tin, doesn't it? Using the same digital token more than once.
Precisely. If you have a digital dollar, what stops you just, copying that data, sending it to two different people at the same time?
Before Bitcoin, that needed a middleman.
Right.
A bank or something.
Exactly. A trusted third party, like a bank or maybe a payment processor. They were the single central ledger keeper. They verified everything, made sure the money you spent actually left your account.
So Satoshi Nakamoto's big challenge was, how do you get rid of that middleman? How do you make people trust the ledger itself without a central authority?
Mm-hmm. And the fix, it involved two main technical ideas working together. First, you cryptographically chain transactions. That's the block in blockchain, and you timestamp them.
Creates an unchangeable record.
Supposedly, yes, an immutable record. But the real secret sauce, the crucial part, was the way to get distributed consensus. For Bitcoin, that was proof of work. Pow.
Okay, proof of work. For anyone not deep in the weeds, what does that actually, do? What does the network have to do?
It basically forces the network to do a ton of computational work, solving really complex math puzzles. It uses a huge amount of energy, huge amount of processing power, or hashing power, they call it.
And that's intentional, making it hard.
Oh, absolutely.
Yeah.
It's designed to be slow.
Mhm.
And really, really expensive. That huge cost, that barrier to entry, that's what makes it secure. Because trying to cheat, trying to tamper with the chain would cost an absolute fortune.
But that cost, I mean, economically and environmentally is pretty significant, which led to newer systems, right?
Mhm.
Like proof of stake, which Ethereum uses now.
Exactly right. After the merge, Ethereum switched. Proof of stake, or POS, it swaps that heavy computation for locked up capital, staked crypto.
So instead of miners burning electricity,
Validators lock up their own coins as collateral. Security comes purely from economic incentives. If you try to cheat the system as a validator, the network automatically takes your staked coins away, burns them. And it's fascinating, this core trade-off. It defines different blockchains. PoW, like Bitcoin, it goes for absolute battle-tested security, but it's slower. POS, like Ethereum, tends to be much faster for transactions, but its security relies entirely on people not wanting to lose their staked money. It's always this tension, speed versus security.
okay, that's security structure. It brings us right to the biggest technical threat people talk about, especially for maybe newer or smaller chains,
Yeah.
the 51% attack.
Yeah, this is the bogeyman, sort of. It's where one person, or maybe a coordinated group, manages to control more than half the network's power, so over 50% of the hashing power in proof of work, or over 50% of the staked coins in proof of stake.
And if they pull that off, what can they actually do?
Well, if they get majority control, they essentially become the network dictator temporarily. They can decide what the truth is. They could block legitimate transactions, maybe censor certain users. And crucially, they could pull off a double spend attack on a massive scale. They could send crypto to someone, wait for them to accept it, and then use their 51% power to rewrite the recent history of the blockchain, reversing their own transaction, spending the same coins again.
Wow, okay. But the sources we looked at, they emphasize that for big networks, Bitcoin, Ethereum, this is almost impossible. Just too expensive.
The cost is the defense. It's prohibitively expensive. Look at Ethereum's staking defense again. To even run one validator node, you need 32 ETH. That was what, around $95,000 back in mid-2024.
95 grand just to participate as one validator.
Right, and if that validator acts maliciously, tries to cheat, the protocol automatically slashes its stake, burns those tokens. So imagine trying to get 51% of all staked ETH. You'd need billions of dollars, and then if you attack, you're basically setting fire to your own billions. It's financial suicide on a colossal scale.
Okay, so the big networks sound pretty safe from that kind of system-wide collapse. But individual users, they're still vulnerable, right?
Yeah.
To attacks that exploit delays, not control. How do we protect ourselves at the user level?
Right, the macro defenses are strong on major chains. But the network security doesn't protect you from, well, making a bad call when things are still pending. The absolute #1 defense for you, the individual user, is simple. Never accept unconfirmed transactions. Ever.
Wait for the network to give the final okay.
Exactly. Many modern wallets help prevent this. They might flag unconfirmed funds, but you still need to be aware and check.
And relying on that unconfirmed status, that's what opens the door for smaller attacks, like the race attack.
Precisely. The race attack is all about exploiting that network lag, that time before confirmation. A scammer sends 2 transactions almost at the exact same time.
Okay.
One goes to you, the person they're trying to pay. The other, conflicting transaction, goes to another address they control, basically sending the money back to themselves.
And they're hoping.
They're betting their second transaction, the one that cancels the payment to you, gets confirmed by the network first. If you accepted the payment based on seeing the first unconfirmed one, poof, the money's gone back to the sender. They keep the coin and whatever you gave them in return.
Nasty. Okay, and then there's a Finney attack, named after Hal Finney, right? This sounds even trickier. Needs the attacker to be a miner or staker.
Yes, this one's more sophisticated. The attacker has to be involved in actually producing blocks. Let's try an analogy. Imagine the attacker is both a magician and a miner.
Okay.
This magician miner has already secretly created a valid block of transactions on their own computer. They haven't shown it to anyone yet. Inside that secret block, they've included a transaction sending some coins back to themselves, effectively double spending.
So they've pre-planned the cheat.
Exactly. Then they make a normal transaction with you, the victim, maybe buying something online. They send you the payment.
And I see it pop up in my wallet. Looks legit. Maybe I ship the goods.
You ship the goods, trusting that initial transaction. But here's the trick. The attacker was holding on to their secret, pre-mined block. As soon as you confirm you've shipped, or maybe just accepted the payment, they release their secret block to the whole network.
The one that reverses the payment.
The one that sends the money back to them. And because they're a miner or have some influence, they might get their version of the block accepted by the network first. It overwrites the transaction to you. You got tricked by an unconfirmed payment they'd already planned to cancel.
Wow. So again, the defense is wait for confirmation. Several confirmations, maybe?
Wait for proper network confirmation. It prevents both race and Finney attacks on large chains. It makes them impractical. Oh, and briefly, there's also something called a Sybil attack.
Right, Sybil. What's that in a nutshell?
It's basically creating lots and lots of fake identities or nodes on the network to trade and gain outsized influence. It's often like a precursor or a smaller scale attempt that could lead to a 51% attack if successful. But it's about overwhelming the network with fake participants. Less common now on robust networks, but still a theoretical vector.
Got it. So waiting for confirmation is key for those on-chain tricks. But here's maybe the most crucial point for anyone listening. The vast, vast majority of crypto losses people actually experience.
Yeah.
They don't happen because of some complex 51% attack or Finney attack.
No, not at all.
They happen off-chain. Or just user error, which we don't talk about as much.
That is the stone-cold reality. Let's just take user error first. Simple mistakes. Estimates suggest somewhere between like 11% and maybe even 18% of all Bitcoin might be lost forever.
People gone now.
People lose their private keys, forget their passwords for encrypted wallets, send funds to the wrong address by mistake, and because transactions are irreversible.
No takesies, backsies.
None. There's no forgot password button on the blockchain. You lose the key, you lose the crypto. Permanently.
Okay, that's huge. Then you've got the risks from the places we use to access crypto. Exchanges, the wallets, the centralized parts.
Yeah, counterparty risk. It's massive. Yeah. Exchanges are basically banks for crypto, right? They hold huge amounts of customer funds. Centralized honeypots.
Prime targets for hackers.
Exactly. When an exchange gets hacked, and many have been, for billions of dollars over the years, the funds are stolen. The underlying Bitcoin or Ethereum protocol might be perfectly secure, but your coins held at that exchange are gone. The failure is at the company level, the server level, not the blockchain level.
And now, with DeFi, decentralized finance, there's another layer, smart contracts.
Smart contract risk. Yeah. These are bits of code that run automatically on the blockchain. If that code has a bug, an error, an exploit,
someone can drain the funds.
Instantly. Think of it like a digital vault with a programmed lock. If there's a flaw in the lock's code, a clever thief can open it and empty it. And again, once that code executes on the blockchain, it's usually irreversible. The problem isn't the chain itself, it's the application, the complex code built on top of the chain.
Okay, makes sense. Before we jump fully into the investment side, let's quickly loop back to double spending itself. We talked about money, but if blockchain is just a ledger, this can apply to anything represented by a token, right? Not
Well,
just currency.
Absolutely, good point. Double spending, at its core, is about faking or invalidating a digital claim on a ledger. So imagine a different kind of token, say a governance token, like Uniswap's UNI token. It gives you voting power in how the Uniswap platform is run. It's a decentralized organization, a DAO.
So the token isn't money, it's a vote.
Right. Now, what if someone could double spend that voting token, cast their vote twice, or maybe vote and then somehow take the vote back after seeing the results? Even if the token has zero monetary value, double spending it corrupts the election, the governance process of that DAO.
Ah, I see. So the act of double spending isn't always financial fraud. It's about breaking the integrity of the ledger, whatever that ledger is tracking.
Precisely. It could be votes, ownership of digital art, tracking goods in a supply chain. If you can illegitimately duplicate or reverse a claim, you break the system's trust. Legally, if the token has market value, double spending it is fraud. If it's like a vote token with no cash value, it's probably not illegal per se, but definitely unethical and likely violates the rules of that community or DAO.
And that really highlights how diverse these digital assets have become. It's not just Bitcoin anymore.
Not at all. You've got transactional tokens like Bitcoin designed primarily as payment. You have utility tokens like ETH or Ripple, XRP, used to pay for services on their respective networks like gas fees on Ethereum.
Then the governance tokens we just mentioned for voting.
Yep. And increasingly, security tokens or asset-backed tokens. These represent ownership of real-world or traditional financial assets, like you mentioned the MS token representing a share of a giant sapphire, or tokenized stocks, bonds, real estate.
The potential use cases seem huge, blurring the lines between digital and physical assets.
They are. And that potential is why people get excited, why they're willing to engage with the risks. Theoretically, this decentralized model has amazing advantages, right?
The list is familiar. Getting rid of single points of failure, like banks in the 2008 crisis. Making fund transfers potentially faster, cheaper, especially across borders.
Streamlining remittances, sending money home internationally by using crypto as a quick intermediate step. Bypassing high bank fees. These are powerful ideas.
And it's a big but.
Yeah.
Those advantages come with a heavy dose of reality checks. The risks. Volatility is probably the first one everyone thinks of.
Oh, absolutely. Extreme volatility is just baked into the crypto market right now. Our sources noted Bitcoin hitting maybe $65,000, then dropping hard, then forecasts suggesting maybe $123,000 by mid-2025. These aren't gentle waves, they're tsunamis.
Not exactly retirement planning material.
Definitely not. It makes crypto inherently speculative. You're betting on massive price swings, not steady growth.
And another risk, this idea that crypto is totally anonymous, that seems to attract some shady characters thinking they can't be traced.
Yeah, that's a dangerous misconception. It's pseudonymous, not anonymous. Every single transaction is recorded forever on that public blockchain.
Leaving digital breadcrumbs.
Exactly.
Yeah.
And law enforcement agencies like the FBI have gotten very good at following those breadcrumbs. Remember Dread Pirate Roberts? Ross Ulbricht running the Silk Road dark web market?
Okay.
He used Bitcoin for transactions, thinking it was anonymous. But investigators were able to trace those pseudonymous transactions, link wallets, and eventually connect them back to him. So if they can trace sophisticated criminals, they can certainly trace ordinary transactions if needed. Anonymity is largely a myth.
Okay. And the final big trade-off, kind of ironic given the philosophy, is centralization risk. The whole point was decentralization, right?
It was the ideal, yes, distributed power. But the economics, well, they pushed the other way. Running Bitcoin mining operations or large Ethereum staking operations requires huge investment. It benefits from economies of scale.
So big players dominate.
Increasingly, yes. Mining has consolidated into massive pools. Staking is often done through large exchanges or specialized firms. So the theoretical democracy of one CPU, one vote, or everyone can stake, is shifting towards an oligarchy control concentrated in the hands of a few large entities with the most computing power or the most capital.
Okay, so we have technical risks, user risks, market risks, centralization risks, and then wrapping around all of it. Regulation. This seems like a huge point of friction.
It's a massive factor. You have this borderless, decentralized technology, and then you have national governments, very centralized,
Yeah.
trying to figure out how to control it, tax it, regulate it, and they're all doing it differently.
Yeah, it's uncertainty.
Huge uncertainty. Look at the U.S. Is it a security, a commodity? Depends who you ask, who's buying, maybe which agency is looking at it. Institutions might face securities laws, retail investors, maybe not. It's confusing.
Meanwhile, Europe.
The EU passed MiCA the markets in crypto assets regulation, a big, comprehensive rulebook for the whole continent, trying to create some clarity.
And Asia is all over the place.
Completely. China has essentially banned most crypto activity. Japan, on the other hand, recognizes crypto as legal property. South Korea has its own rules. It's a total patchwork.
So as an investor, you're not just betting on the tech, you're betting on which way dozens of different governments are going to jump.
Exactly. That regulatory risk is enormous and unpredictable.
So pulling it all together, the tech, the risks, the market, the expert view seems pretty clear.
Yeah, the consensus from the sources and just generally remains pretty firm. Because of the crazy volatility, the very real risk of losing everything through a simple mistake or an exchange hack, and this cloud of regulatory uncertainty. Cryptocurrency is really only suitable for speculators, people who fully understand they could lose every penny they put in and are okay with that level of risk.
Not for your retirement savings, not for your must-grow portfolio.
Definitely not. It's high risk, high reward speculation, full stop.
Okay, so we've come full circle, haven't we? We started with that elegant technical problem. Satoshi solved double spending, the very foundation. Then we traced it through. The core protocol, especially on the big chains, seems incredibly secure against those fundamental attacks. The cryptography holds up.
Largely, yes. The core tech is sound.
But the real-world losses, the
Well-
danger points for most people, they come from the complexity. The fact there's no intermediary to help if you mess up. They come from the ecosystem around the blockchain, your wallet security, the exchange you use, the smart contract code you interact with. That's where things break.
That's where almost all the money is lost, realistically. Human error and failures in the surrounding infrastructure.
Which leads us to that final thought we wanted to leave you, the listener, with.
Right. We spent, collectively, decades solving the technical problem. How do you trust a digital ledger without a central bank? How do you stop double spending in a decentralized way?
And the evidence suggests that for the major cryptocurrencies, that core technical problem is largely solved by having large, fast, robust networks with strong economic incentives.
So, if the tech hurdle is mostly cleared for the big players, could it be that the biggest remaining barrier to crypto truly going mainstream to widespread adoption isn't technical anymore?
Is it actually the regulatory mess? This fragmented, slow-moving, often contradictory global patchwork of rules that governments are trying to wrap around a technology that's inherently designed to ignore borders.
The battle might have shifted from code to legislature, something to think about.